Where did quantitative trading come from? Is this a brand new thing that just happened in the last 5, 10 years, or has it been around forever? Traders, welcome to the Independent Quant Podcast. I'm Luis, the founder of the Independent Quant. This is episode 2 of the Independent Quant Podcast. And in this episode, we're going to talk about the history and development and evolution of quant trading. We're going to go look at the history of quant trading over a 3-phase period going from the 1950s to the present. And with that, let's just jump in. So is quantitative trading a new development? It's not. We can trace its roots back to the 1950s. Between the 1950s and 1980s, we see a lot of the theoretical foundation being set for what would have today, which is quantitative trading. During those decades, we had several key figures like Harry Markowitz developed the modern portfolio theory. Then Eugene Fama in the 60s developed the efficient market hypothesis. And then Ed Thorpe, considered to be one of the founders of quant trading, or one of the first quant traders at least, started applying probability theory to trade statistical arbitrage and option pricing models. So throughout those 4 decades, we start to see the foundation for quantitative trading start to be set. Now, what's important about that is there was not the computing power to do a lot of these things that these men were uncovering or saying the foundations for, right? During the 50s and the 60s, programming was very much in its infancy. We had punch cards that's how computers were coded. Fortran was it's in infancy. There was just not the robust computing necessary to do a lot of these strategies. Computers took up entire rooms back in those days, if not entire floors. And those for computers that our phones are far more powerful than anything that existed during that time frame. Regardless, they gave us all the foundations and the way to at least approach the markets using a mathematical way, using models to approach the market. Coming into there, we said in the 1950s to the 1980s, but then as we entered the 1970s, that's when options were born as an instrument. They weren't very popular at the time. The first options were call options. The puts came in about 4 years later. It wouldn't be for another 40, 50 years when we started to see the spike in options trading in the early 2000s. But in the early 70s, when they were introduced, there was no way to price these options. Nobody knew how to arrive at a price for options. And for that, Black-Scholes model was developed, but that set the foundations of how to arrive at pricing when we don't have an open market or have a way to arrive at a price. This predates personal computers and really robust networks. So brokers were now able to take orders from their clients and find some theoretical price that they could charge for an option. That in itself started now developing that pricing model that we'd see as things started picking up as we went into the 1980s and in the 90s. In the 80s, we started seeing electronic trading started to take off. Computers were not what they were in the 50s, 60s, and 70s. Now the personal computers were coming into existence. The size of computers were beginning to become much smaller, and we had computing power available to do a lot of the work that was necessary to do these electronic trading. Now, statistical learning, which today would eventually evolve to be machine learning, that started in the 70s, and it was starting to be implemented somewhat going into the 80s. However, a lot of the really robust models that we have today didn't have the computing power back then to do. Regardless, we still had now electronic trading happening. The birth was there. Big companies were using it. How much independent traders were doing it? I couldn't find any historical information to verify that it had gotten strong enough that people were doing it off of personal computers. You have to factor that at this time period in the 80s, if anyone had internet at all, it was, and even the internet was in its infancy, but if anyone even had anything that resembled it, it was probably a bulletin board service or something that worked over dial-up. So it wouldn't be something that we'd today be considered as robust as necessary to do any real high development strategies. Now, that said, as we came into the 90s, that really started to shift because we started seeing firms like Citadel and Getco started getting into high frequency trading. High frequency trading is when firms take hundreds, if not thousands, of trades a second going in and out of positions, trying to exploit different edges that they see in the market. That was something that had happened in the 90s. But that computing power is now started to trickle down into home computers. I remember in the mid 90s, we still had dial up. That's how I connected to the internet back then in high school. We eventually got it into my house, but the internet wasn't what it is today. There really wasn't much to search and do on the internet. We would have to wait until the 2000s to really see that growth. And that's really when we say the democratization of quant trading began to happen. So at that point, Python, which is a programming language, was about 10 years old. It was starting to get established itself among several communities. It wasn't what it is today, but it got to where it is today because of the work that was happening during that time frame. We started seeing a lot of development in a lot of other programming languages that would help facilitate trading. The first language I started learning that lended itself to this was R, to statistical programming language. That really lent itself now to helping apply a lot of modeling and statistical uses, statistical model to model the market. And we also have to remember that around 2004 is when AWS was born, and they first released their first service, which was S3, their simple storage solution. From there, things just kept growing, right? That introduced the cloud. So between the cloud and the development of these programming languages, that really opened things up as we entered the 2010s, when now we had big data in the 2010s, and then what to do with that data, how to process all that information. Now we had the computing power and the cloud to be able to compute all of that. Machine learning was starting to hit its stride in mid 2010s with a lot of different resources where you weren't bound by your own computer to be able to run models and try to emulate or create strategies for trading in the markets. And now here we are in 2025. Generative AI has already changed the world. We can query and create strategies just by interacting with the technology these days. So we've come to this stage now where we had theories in the 1950s to 1980s, to then finally having the computing power, but it being reserved to large firms. We had the 90s then have these large firms really take a hold of it. Enter the 2000s, all that technological, breath started really hitting just everyone's homes, and we are where we are today. Quantitative trading is not the future. Quantitative trading is the world that we're living in right now. And I'd argue that if you're not applying these technologies and this skill, at least systematic or algorithmic strategies, even if all you're using it for is to locate signals to determine whether or not to take a trade, I'd say you're very far behind, and it's worthwhile for you to at least explore if it fits. I'm not saying that everyone has to use these, but you should at least make a informed decision as to whether or not it does or does not fit within your financial goals. So with that, if you don't know how to get started in this, then head on over to theindependentquant.com, sign up. We've got weekly podcasts where I do deep dives into all matters related to quantitative trading. And if you want to get started, we have courses available for you to sign up for. And you can see me documenting my journey as I build an algorithmic trade desk. So until then, keep it green. I'll see you in the next episode.